Yeah, I have a question online, Alex.
Yeah.
Please address why that position, I guess the IBM position, wound up with a minus 700 delta.
Okay. Sure. The reason that the position ended up with a minus 700 delta is we ended up with, and I'll actually correct that, the option position ended up with a minus 700 delta. We ended up net long 300 shares of stock, and therefore the overall position was actually closer to minus 400 short deltas. But getting back to why the position had the option position had a minus 700 delta, we started off fairly close to zero, short about 100 deltas. As the stock went up, remember that we started with 10 straddles, and therefore, at the extremes, if the stock went way up or way down, at the extremes, the maximum our delta could have ever been is 1,000. Okay, because we have 10 contracts, which is equivalent to 1,000 shares of stock. So we would have either had 1,000 long shares if the stock went to zero, or 1,000 short shares if the stock went up infinitely. We went up $10, and therefore the put option started, being $10 out of the money was pretty close to worthless. I think it closed out at about 75 cents. The call option, which was $10 in the money, was the one that had the majority of the deltas. And that, being $10 in the money at the time, it actually, it wasn't completely, the time value hadn't completely eroded, so it wasn't a perfect 100 delta option. It was probably about an 80 delta option, and if you think about that, or it was maybe about an 85 delta option, and the put was maybe then a 15 delta option. So you see that the net would have been, the net between the two would have been about a 70 delta, which over 10 contracts would have been 700 deltas. And remember that you're short these calls. And when you're short the calls, as the delta gets bigger, the deltas get bigger and bigger in a negative manner. And so as the stock increased and got these calls pretty close to, $10 deep in the money, these calls started to really pick up a, started to really pick up a negative delta. So that's how we ended up with the 700 net short deltas on the position, is because the stock went up, the calls went more and more in the money.
Go ahead. If the stock goes up, you end up with a negative delta position. So to compensate, you would go buy stock. On the other hand, if the stock price goes down, would you short the stock if you ended up in a positive delta?
Yes. If the stock went down, we would. If the stock went down instead of up, we would have sold. We would have sold off deltas. We would have shorted deltas, because what would have happened is, if the stock goes down below 75, let's just take it one option at a time to make it kind of simpler. Take the option that ends up in the money, which in this case would have been the put. If the stock goes below 75, you have an in-the-money put. And the in-the-money put gets more and more and more. It picks up more and more deltas the further it gets in the money. And these are going to be, at the end of the day, because you're short the puts, and puts have a negative delta, but because you're short the puts, you're going to end up with a bigger and bigger positive delta. And so if you just let the short straddle position continue on, what you're going to end up doing is you're going to end up getting longer and longer and longer deltas, even though the market's going down. So the further the market goes down, the more and more money you're losing. So not only are you losing money, but you're losing money at an increasing rate. And so in order to get away from that, in order to minimize that loss of money, we would have to sell stock short in order to in order to minimize that effect. In order to, as the market starts collapsing, we need to sell stock short to keep our deltas under control. Because we might be willing to lose some money, but remember, there's a difference between losing on your small delta versus losing when your delta gets bigger and bigger as the stock goes lower and lower. So in order to control that element, yes, we would short stock, which for a lot of you may lead to a margin situation where, and most of you have a margin account, but unless you're trading with new margin rules, and you have portfolio margining, you're going to run into the notion that you're going to have to put up some money for the stock. That being the case, you will have to likely explore the notion of hedging with options rather than hedging with stock.
Does it make any sense to try and manage a whole portfolio that way?
Does it make any sense to try to manage a whole portfolio that way? That's a good question. It's from, and again, I'll go ahead and just put in the disclaimer from my experience. What I would do is I would handle because again, and the reason I'm doing this is because I did handle over 40 simultaneous positions as a floor trader, so I figure that's at least relevant enough to look at. What we would do is, from each one of those positions, if all once you trade it, when you trade on the floor, it's impossible, let me restate, impossible to remember every trade you're going to have on. The biggest reason is you have so many. The second reason is they weren't your idea in the first place. They were someone else's idea, and you took the other side. So it's impossible to keep track of any one trade. So what do? We can't. We have to keep track of the Greeks. So the only thing we look at is the Greeks. And we look at the delta, and the biggest thing, vega, theta, gamma, those things are difficult to assess, to really react to. But delta, one of the cardinal rules of trading is that delta is the easiest risk to hedge. One of the cardinal rules of options trading, delta is the easiest risk to hedge. Why? Because you can always go out and buy or sell stock to get yourself back to a level of comfort. So the one thing that we could do, if a position got too big one way or the other, the one thing that we could quickly do to address that was to hedge the delta. And so that's what we would do. And so we would do it for individual stocks based on these huge positions. I happen to be fortunate enough to work for a big firm. Now, the firm as a whole, even though we hedged our own positions, there was still a lot of stuff that we couldn't possibly hedge on the trading floor. And therefore, the firm had an aggregate portfolio of all of our positions, and they would also go ahead and actually hedge off those positions in, they would go ahead and hedge the aggregate position in a portfolio type of manner. And sometimes you would say, you know what, we're net long as a firm, and basically since we're trading over 1,000 stocks, you got to figure that if you're trading over 1,000 independent stocks, then you basically are trading the market. And if that being the case, you can hedge that aggregate position by buying or selling S&P futures. And so yes, the long convoluted answer is yes, you can do that. The follow-up question to that is, can you do something similar with just options? In other words, if you find that you're getting, your portfolio is getting long volatility or short volatility, can you trade options to hedge that volatility? Can you, if you have a lot of equities, can you trade index options to hedge the volatility? The answer is yes. You have to become familiar with something that, you can always do a Google search on this. It's called dispersion theory. In one of our classes we did a really excellent basic write-up of what dispersion theory is so that you understand why certain elements happen I spent a little bit of time on the index desk at Susquehanna when I was training, and one of the things I picked up was the notion of dispersion theory and how we would use that to hedge a multiple stock position with index options. And what were the risks that we were taking when we did that, because it's not a perfect hedge because of this element called the dispersion.